Welcome to today's event where we have the pleasure to present Össur. To help us through today's presentation, we are joined from the company from CEO Sveinn Sölvason. Today's event will cover the full year report you released last week, both with it looked to me like a quite strong finish to the year, and also with you guiding decent good growth into next year. As always, you can ask questions in the box down below. Do it in Danish. I will try and translate to the best of my ability, but for certain, for reason, we of course do this presentation in English. But for now, I think I'll hand the call over to you, Sveinn.
Thank you very much, Michael, and hello everyone, and thanks for joining us here this afternoon. I will, for those of you who are new to the Össur business, I will go through just a few slides here in the beginning, and then say a few words on our 2023 results and what we expect for 2024. As a reminder, Össur is a global medical device business. We operate in 36 countries, everywhere where there is a healthcare market where there is demand for our products. We have over 4,000 employees across the globe. We have always been a technology company. We invest about 5% of our overall sales in R&D and have over 2,000 patents with regards to how mobility devices are fitted to the external body. Ever since the company was listed on the stock exchange in 1999, we've demonstrated profitable growth, and on average 17% growth since listing in 1999, and always healthy profit margins. Just a little bit about the segments that we operate in. Prosthetics is our largest segment, 46% of our sales in 2023. This is where we supply components to build legs and arms, and for people who've lost a leg due to either dysvascular sort of complications as a result of diabetes or as a result of trauma. And we make everything that is needed to build a prosthetic leg, both what we refer to as mechanical solutions, but also bionic solutions, which are components or products that have some sort of artificial intelligence or some motors or some other means of helping the end user move more freely. Then we have our bracing and support business, which is 18% of our sales here in 2023. These are products that are used for often rehabilitation purposes or preventive purposes, and here we have a very broad portfolio offering all bracing solutions that are needed for everything from minor complications to more let's say complicated higher end products. And then finally, our patient care business. This is where we serve individuals that need our products, and we have a presence in patient care in most of the well-established global healthcare markets. Now, the company has, as I mentioned earlier, always grown since we listed in 1999, demonstrating 17% growth over this period, growing from a one product business in 1999 to then, let's say, a global healthcare company or health product company. And then in recent years, moving forward also in terms of servicing the patients that need our products, owning patient care facilities in most of our markets. And that brings me to this picture here, which is a nice way of capturing where we are now as a business, transitioning from being a very focused, you could say, niche product business to operating in the overall value chain that serves people with a chronic mobility challenge. Everything from being a product provider to delivering the service to those individuals that need these products. This is the company that we are building today, and again, from being as very product focused to now being more patient centric in everything we do, and where the majority of our business is addressing mobility challenges that the individuals that need our product and services will need some sort of support for the rest of their lives. Now, so that was a little bit on the big picture. If we then move on to highlights for 23, we announced our 5-year growth strategy at our Capital Markets Day in March last year, which was a lot about these themes I talked to on the earlier slide, from product to patient. We have raised the transparency in terms of our segmentation, where we now report on the 3 segments: prosthetics, bracing, and patient care. And if we look at 2023, we saw very healthy growth across all our product segments and all of our geographies. And with regards to profitability, our profits or our EBITDA grew in line or a little bit faster than our top line growth. Innovation remains very important for us and has always been a big growth driver. We go into 2024 with a very solid pipeline of new bionic launches. And also here towards the beginning of the year, there were big news in our industry where both we acquired a company called Fior & Gentz, which provides components to build solutions for individuals that have suffered a mobility impairment, mainly as a result of stroke. Fits very nicely into our picture, both from a, let's say, a technology standpoint, but also because we in our patient care facilities and also what are our main customers, O&P clinics, serve individuals that have these sort of mobility challenges. So it fits very well into our overall strategy. And then finally, what was a major announcement in our industry here in the beginning of the year was the announcement from Medicare that Medicare is the public payer in the US regarding more coverage for more individuals for more higher-end solutions. So that was probably, if this goes through, the biggest change we've seen in reimbursement historically in our industry. Just a little bit more about the numbers here. You see our regions and our segments, solid growth across all regions, 8% in Americas, 10% in EMEA, 10% in APAC. And then if we look at the segments, we group our prosthetics business 13% here in 23, bracing 3%, and patient care 8%. And on the far right, you see profit margins that are stable in a year where we did see unprecedented inflation impacting our cost structure. So overall, we believe this to be a sign of stability in our business, that we are able to keep margins stable in this what has been somewhat a turbulent environment on the cost side. Cash flow strong here in Q4. We did have some unusually high CapEx during the year, which we expect to be lower here into 2024. Our net debt to EBITDA was at the higher end of our range here towards the end of Q4 and will be a little bit above our target range here after the completion of the acquisition of Fior & Gentz. Here we then have our guidance for 24. We guide 5 to 8% organic growth. We expect to raise our margins from 18% to guide now 19 to 20%. And then for other parameters, CapEx lower than last year and stable effective tax rate around 23 to 24%. And this aligns well with our growth ambitions that we announced as part of our Growth 27 strategy at the Capital Markets Day last year, where our overall ambition is to grow the business 7 to 10% in local currency, which is a healthy combination of solid 5 to 7% organic growth and 2 to 3% acquired growth on average. And last year, 9% growth, which was organic growth. We didn't have or hardly any, let's say, contribution from acquisitions last year. So on the organic growth side, we delivered above our these targets here in 2023. That was a quick overview, Michael. I think I'll hand it back to you for some questions.
Perfect. There's a question. Do you expect more acquisitions in 2024? And is your balance sheet suited for this? You know, both your balance sheet, are you able to absorb that in your organization? And also looking at this acquisitive growth on average, is Fior & Gentz enough to deliver on that target? So a little bit about your plans for M&A.
Fior & Gentz is, let's say, will take the box in terms of M&A contribution here for 2024 as such. And M&A is always Well, timing is one, balance sheet capacity is another thing, and then just internal capacity to bring an acquired company on board effectively and deliver on synergies. These are always considerations we have to go through at each and every time. Now, we do believe that there are opportunities to grow our business through strategic acquisitions, both in terms of buying product or technology like we did with now Fior & Gentz and Naked Prosthetics end of 2022. We do believe there are also opportunities to expand geographically, and we believe that there are also opportunities to selectively grow in patient care in our core market. So we have a pipeline and we'll continue to monitor opportunities in all these three categories. However, as we've now consumed Fior & Gentz, which was a fairly big acquisition for us, we're likely not to enter into any major projects here until at earliest second half of the year, and I do expect us to be within our target range here at the end of 2024 again.
So when we look at the acquisitions, they can both be used just to really bolster up like a Fior & Gentz and get more in your sales person. But I also guess you also are looking at emerging markets. And I guess patient care is. Yeah. Are you needed to trigger to buy something out there? Whether you have the balance sheet or to deliver on that, or is it not nice to have, but to deliver on your growth journey? Is there something you need to pull the trigger on a little bit earlier on in the project phase than others?
No, not as such. I mean, we let's say, I mean, all of these different types of acquisitions are strengthen our business in different shape and form. I mean, emerging markets as a growth theme for us is incredibly important, and we are growing very well in all of those emerging, or what we sometimes refer to as private pay markets, in the contrast to public pay markets here in some of the Western European and US countries. So we absolutely see opportunities for more acquired growth in emerging markets, but those are typically smaller projects and more where we are in some cases buying distributors who have been our partners for a longer time.
So it's not needed. It was more what I asked you. Do you need to pull the trigger to continue this growth? So there you are saying no.
No, not really. No.
Then there's a question, the margin improvement, how much is that coming from higher prices and the Fior & Gentz acquisition? I guess you landed around 18 and next year we're guiding 19 to 20.
Yes, we're guiding 19 to 20, and that is partly related to us improving unit cost. Unit cost has been under pressure here over the last couple of years, mainly because supply chain challenges go as a result of all the supply chain turbulence that came about as a result of COVID-19. And we have been, because we used to have a lot of single vendor relationship, because on the prosthetic side, we are not a big buyer of electronic components and all sorts of other critical elements. So we've been restructuring our supply chain, and that has put some pressure on our unit cost. And so we need to make progress on that here in 2024, as well as we expect a good top line growth and the underlying scalability that we have in our cost structure to deliver the expected margin expansion.
So if I hear you correctly, it is you who need to execute on getting the unit cost down. It's the top line who needs to grow, but there's no external factors coming in, like you need to raise prices and get us to. It is more up to you actually to drive that than external factors
That's correct.
Something should happen and then you raise your margins.
No, that's correct. I mean, we do expect minimal, let's say, price increases. We did see price increases here in the beginning of 23, but much lower here going into 24 as inflation expectations and inflation rates have come down in virtually all of our major markets.
And then what are the main reasons you expect a slowdown in growth in 24 compared with 23?
It's mainly price. Price increases were to the tune of 3 to 4% here in 23 and are lower going into 2024. So it's mainly that differential that leads to let's say that the upper end of our guidance is not at where we delivered organic growth here for 23. And it's also fair to say that there was perhaps some element of pent-up demand or demand, let's say, or individuals that did not get an upgrade or get their device serviced here in the last couple of years and came into market here in 23. So the pricing component and some element of pent-up demand that we are not expecting to see here in 24.
Then next question, can you give some flavor on the potential increase in sales due to the Medicaid changes? You called it some of the biggest changes you have seen here. And I know you need to be careful, and I know it needs to be still seen how this will pan out. But can you give any flavor on the potential sales increase from this?
I am hesitant to put a number on that as such, but I can though say that Medicare that is proposing these changes, they cover, we estimate, 25-30% of all payment for amputees in the US. And if you look at this, the current or look at a recent year for Medicare, about half of the volume of claims are related to high active patients, which constitute about 90% of payments made. While the other half, which are the low active patients that will now get access to high-end solutions, constitute the same amount of volume, but only 10% of the value of payment made. So theoretically, the market could grow quite substantially if these changes go through. And this is obviously great news for amputees, and I would also say for the system as such, because these individuals that do get access to better mobility devices should all else equal be healthier, and the overall cost burden for the system should go down as a result of this improved access to good mobility devices. So that's just first and foremost is great news for both amputees in the US market and the US healthcare system, I would say.
Yeah, and that was my next question. I was sitting and wondering, it normally very hard to get the higher reimbursements and a change in that. So the reasons behind it, is it your data showing a lower cost? Is it them observing that maybe they can get mobility or effectiveness, productivity out of this? Because if I understand it correct, it has been the higher activity people who has gotten the access.
Yeah.
And so can you elaborate a little bit on that? Because maybe that will make us understand how likely it is that actually this will be a good scenario for both patients, you and the systems.
The industry has been pushing for this for a long time, and this is not something that has come about just from one day to the other. There's a lot of work in the background showing economic studies or health economic studies, outcome studies that demonstrate that that the lower active patient population would benefit from using better mobility devices. So that is. And then the system has looked at that constructively and decided to take this step. But as I mentioned earlier, this will provide some. There's some things we know, some things we don't know. For example, what will the private insurers do that cover the other 75% of the market in the US? That'll need to play out. But we'll take it step by step. But I think most importantly, this. Our assumption has always been that gradually bionics will become standard of care for amputees, and this is just a major step in that direction, and we are happy to see healthcare authorities in the US take this very positive step.
And a little bit of a cheeky question. Looking at your long-term growth rate, if this really comes true and it happens, could that actually mean that you should change your long-term growth rates? I'm trying to get a feel on, is this percentages on, with such a huge market, such a big change, You're very welcome not to answer it, but just to get a feel of it, could it really change your 5 to 7 organic growth per year if everything pans out and when you're ready to do it and everything has fallen into place? I know that's not going to happen tomorrow.
Well, theoretically, yes. I mean, the US is almost half of our business, and it's the single biggest payer for everything we do today. So if they decide to open up access for more amputees and that our product portfolio is eligible for these changes, which we think it will be, then it can have an impact. But it's way too early to confirm anything like that. We just need the proposal is still subject to industry commentary. We need to see how that lands and timing, and there are all sorts of uncertainties. But theoretically, yes.
And sometimes we see this where and I'm more from the pharmaceutical side, that when one country changes anything, it changes maybe other payers around the world's way of looking at it, looking at the data. If one big country, the UK or European does it, it might sometimes have a knock-on effect on people looking differently at data. Could you see such an effect anywhere, or are the rest of the world or the Western world, are they covered like you now would like to have US covered? Is kind of my question.
I mean, this could also be a start, let's say, or I would say accelerate this trend of bionics, because again, the US is a big market, which means that volumes will, in the whole industry, for bionics will increase, and that all else equal should lower unit cost. And as we go forward, this should help adoption in other countries. Yes, that is certainly also a plausible scenario, for sure.
And then there's a question: the 1 to 2% point in margin increases you expect this year. Is that something we could look after in the coming years also, or is there anything extraordinary that lifts this year, the 24, compared to the next one? So we're a little bit asking. I think in your long-term growth and business, you have margin improvement as a guiding tool. But so to ask a little bit, is this special this year? Is it like you see the ketchup effect, or I know you're not guiding on every year, but just to get a little bit feel on how we should look at improvement this year.
Well, what we've demonstrated historically are gradual margin improvements that are driven by product mix, principally our prosthetics division growing faster than the remainder of the business. We've had historically efficiency in terms of our unit cost, lowering unit cost every year. And then we have had scalability in our OPEX structure. This has consistently delivered margin improvement in our business. However, last couple of years with the supply chain disruption and inflation, we've not seen margin improvement here over the last 2 years. But we expect those underlying drivers are still there. The operating model to deliver on gradual margin expansion as we have healthy top line growth should still be there. But what we've learned also over the last couple of years with uncertainty in the external environment, that a lot of things can happen. So this is our best estimate here for 24. Yeah. This is what we know now, just given the assumptions we have around development. But going forward, we will just have to take it one step at a time.
And then there's a question, the last question: are there any changes coming on the grant side, reimbursement side, of is threatening that could potentially affect you negatively in 24? And have you included that in the guidance in somehow?
We are not knowledgeable about any reimbursement changes in any big markets that could have a fundamental impact on how our business is developing. Reimbursement changes have been more in terms of systems gradually opening up for these high-end products. Therefore, let's say reimbursement has been on average increasing. But with that being said, reimbursement systems are always trying to lower cost and are always finding or searching for ways to increase efficiency in terms of how healthcare is delivered, and we need to always fight for what we every day are striving for, just better increase for amputees, and it's tough out there. Healthcare systems are always and need to find, just given all these macro or big picture trends, like an aging population is putting a tremendous pressure on healthcare systems. But then again, we need to just remember that what we do, raising mobility, increasing mobility levels, all else equal, is positive for healthcare systems in terms of cost burden.
Perfect, Sven. That was the last question. Thank you for taking us through your results and taking your time to answer questions. May everybody have a nice day.
Have a nice day.